The stock market just hit a record high, and if you are retiring in the next few years, that probably did not feel like good news. Everyone assumes a record high means it is time to take something off the table. The S&P 500 closed Friday at 7,757 after 5 straight sessions of buying, and bullish sentiment is the weakest it has been in over a year. Those two facts belong together, and between them, they explain most of what happened this week. I am going to walk you through what actually moved, the 3 things worth your attention, and by the end, you will know whether any of it touches your plan. Here's the short version, and then I will show you the work. It almost certainly does not touch your plan. If you appreciate me making this type of content, let me know by gently tapping that like button. Let's get into it. This content was created with the assistance of third-party artificial intelligence and was reviewed and approved by David Berkowitz prior to publication. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay for it. David runs VAP Wealth Advisors. He spent 40 years as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant, and he trained me on all of it. So you get his experience while he's meeting with clients and researching companies. He reads every comment, he writes every lesson. Every major index gained, and the ranking of those gains tells you what changed. SPY, the S&P 500 ETF, gained 3.5%. QQQ, the Nasdaq 100, gained 5.1%. RSP, the equal weight S&P 500, gained 2.4%, and IWM, small caps, gained 3.6%. Here is what each one measures. SPY is market cap weighted, so the largest companies dominate its return. RSP holds the same 500 businesses at roughly equal weight, so it behaves like the average stock. QQQ tilts heavily toward large cap technology, and IWM is roughly 2,000 small cap companies, the most rate sensitive of the 4. QQQ led because the week's 2 dominant forces both favor long duration growth, falling rate hike odds, and a fresh wave of AI capital spending news. The gap between QQQ and RSP, 2.7 percentage points in a single week, is the widest since the June sell-off ran the other direction. But look at the bottom row, because year to date the ranking flips. IWM is up 22.5%, RSP is up 14.9%, SPY is up 13.4%. Breadth is still winning the year. Hold on to that, because we come back to it. Volatility confirmed the calm. The VIX closed Friday at 14.90, down 6.8% on the week, and essentially flat for the year. Dr. Ed Yardeni called the turn as it happened. He said the summer stall ended decisively and credited what he labels FEMO, fabulous earnings momentum. S&P 500 forward earnings are up more than 30% year over year. His point on breadth was blunt. Investors rotated rather than retreated. All 11 sectors ranked. Technology led at 7.2%. Communication services 6.1%. Consumer discretionary 5.4%. Materials 4.0%. At the bottom, energy fell 3.4%. Real estate fell 2.5%. Financials fell 1.6%. Technology's week was the semiconductor complex reasserting itself. The VanEck Semiconductor ETF gained 7.8% and now sits up 61.8% for the year. Materials rode a 1.9% gain in copper and a spectacular week in gold mining. Consumer discretionary caught the rate relief bid on Friday. And that was crude, not the businesses. Energy remains up 28.6% year to date. So this was a give back inside a strong year, not a break in trend. One industry group deserves a call out that is not on this chart. Home builders gained 7.2% as mortgage rate expectations improved. That is the direct read-through to your installed building products position, and we come back to it. And gold miners. GDX rose 21.3% in 5 sessions, more than any sector or industry we track, on a 7.1% move in bullion. Gold itself closed at $4,399.70 an ounce. Gold matters here because it is the market's cleanest expression of doubt about the Fed's willingness to hold the line on inflation. When gold and long duration growth stocks lead the same week, you are looking at one story told twice. The market repricing real interest rates lower. Friday's July employment report was the pivot, and it is the single most important slide in this review. Non farm payrolls fell by 23,000 against a consensus near positive 80,000. That is the first outright monthly decline of this cycle. And yet the unemployment rate improved from 4.2% to 4.1%. Both of those things are true at once because roughly 264,000 people left the labor force. Participation slipped to 61.4%. A falling unemployment rate produced by a shrinking labor force is not a healthy signal about labor demand. It is, however, a very effective signal to a bond market that had spent 3 weeks pricing a rate hike. Odds of a September increase collapsed. CNBC reported CME FedWatch showing a 60% probability the Fed holds in September, up from 45% the day before. The 10-year Treasury yield fell from 4.74% to 4.66%. The 2-year traded below 4.17% intraday. That single move is what lifted almost everything on the last 4 slides. Now, here is the part that does not fit. Monday's ISM manufacturing survey went entirely the other way. The headline index rose to 55.6 in July, the strongest reading since May 2022, with production at 58.5 and new orders at 56.7. A factory sector at 4-year highs, alongside a payroll decline, is the defining oddity of this economy. Yardeni's explanation is the AI build-out. Core capital goods orders and shipments hit fresh record highs, up 13% and 9% year over year. He points to Caterpillar, where order backlogs surged 92% year over year. The problem is prices. ISM manufacturing prices paid sat at 71.1 and services prices at 70.3. Neither is anywhere near consistent with 2% inflation. 5 numbers worth writing down from Economic Insights by Business Briefings, which we read every month. 212,000. The average weekly initial jobless claims so far this year, the lowest average since 1969, at a time when the labor force has grown from 81.6 million to 169 million. 54.4. University of Michigan Consumer Sentiment, up for a second straight month off the lowest reading ever recorded in May. Every time this survey has printed 58 or below, the S&P 500 has been higher 3 years later by an average of 51.9%, 4.2%. 1-year inflation expectations down from 4.6%, and 2%, the share of Bank of America fund manager survey respondents expecting a hard landing, the lowest since this bull market began, and 29.6%, AAII bullishness, the weakest in over a year. Historically, readings in that band have been followed by average S&P 500 gains of 12.9% over the following 12 months. Their summary line is the one to hold on to: bullish but not euphoric. If you are finding this useful, hit that like button and subscribe. This review goes out every week. On to oil, and a story that moved the entire commodity complex on a single sentence. Treasury Secretary Scott Bessent told CNBC on Tuesday that the United States is in talks with the Iranians, and that there was a chance of a deal within a day or two to open the Strait. He described the proposed arrangement as freedom of movement. Crude collapsed on the comment. Brent traded below $80 midweek. By Thursday, the deal had not happened. Iranian state media reported a draft plan that would continue to block U.S. and Israeli-flagged vessels, and crude recovered roughly $3 into Friday's close. Net for the week: WTI fell 7.7%. Brent fell 5.0%. That is the entire reason energy was the only sector down on the week, and the entire reason Diamondback Energy was your worst performer. Nothing about those businesses changed between Monday and Friday. Crude matters more than most people give it credit for, because energy is the single largest swing factor in this year's inflation picture. The Hormuz negotiation is a binary event with no useful base rate. We do not position for it. The more consequential global story got much less attention. Japan and the United States conducted their first joint yen buying intervention in decades, acting July 30th and July 31st, after the currency reached roughly 164 to the dollar, a 40-year low. Yardeni put the scale at roughly 34 billion to 36.5 billion on Friday alone. Why does this belong in your review? The transmission mechanism. A collapsing yen risks disorderly sell-offs in Japanese government bonds. Japanese institutions are among the largest foreign holders of US treasuries. Uncontrolled Japanese yield spikes spill into global markets and drive US treasury yields higher. Put plainly, a disorderly move in Tokyo becomes a mortgage rate problem here at home. The intervention bought time. The rate differential underneath it has not changed. The FOMC held the federal funds rate at 3.50 to 3.75% on July 29th by a 9 to 3 vote. All three dissents, from Beth Hammack, Neil Kashkari, and Lori Logan, favored a hike. Reuters called it the first three-dissent vote in the same direction since September 2016. Chair Kevin Warsh has been direct on the target and vague on the path. His words, "There is no soft inflation target. There is no soft implicit target, not on this committee's watch. There is only a target, and it is 2%. Yardeni is skeptical the plan behind the rhetoric exists yet." He describes Warsh as a secret agent with a clear mission to deliver price stability, who is very secretive about his plan for doing so. For your account, the translation is straightforward. The market is no longer sure whether the next move is up or down, and that uncertainty gets resolved one data point at a time. Credit conditions themselves are easy. Net tightening of lending standards came in at 0.0%, down from 8.1%. Which brings us to the argument that matters most this week. Both Alger, the Growth and Innovation Group of mutual funds, and business briefings from the folks at Trends Online magazine describe AI the same way, not as a monolithic market, but as a layered industrial system. Compute, memory, power, models, enterprise adoption. Each layer runs on its own clock. Semiconductor fabs get planned over 5 to 7 years. Financial markets reprice in hours. The consequence, in Alger's words, because each layer of the AI stack depends on the others, a bottleneck in one area can cascade through the broader ecosystem. Scarce memory reduces compute efficiency. Limited power delays data center deployment. Delayed data centers hit demand for chips and equipment, which means one layer can suffer a severe correction while investment surges elsewhere. That is not a market you can own precisely with a single index weighting. Quick break. Everything in this review comes from the written weekly market and value-aligned portfolio review, with every source linked. It is free, it goes out every week, and you will find it in the description and the pinned comment below. Here is that argument as a fact rather than a theory. Coherent, the optical components and laser maker supplying transceivers for AI data centers, gained 44.2% this week. Palantir PLTR, the data analytics and AI software platform serving government and enterprise clients, gained 39.8%. The Trade Desk, TTD, the demand-side platform for programmatic digital advertising, lost 23.5%. DaVita, DVA, the kidney dialysis services provider, lost 23.5%. Same index, same week. An index fund owned all four in proportion to their market values and had no opinion about any of them. Alger's Chris Conti puts it this way: passive strategies do not distinguish between those companies benefiting from disruption and those potentially vulnerable to it. And this is not hypothetical inside your own portfolio. We choose to own Accenture, the premier IT services firm, and it is down 34.5% year to date, but up 5.7% for the week. That is the disruption thesis playing out against us. We also hold ServiceNow, an enterprise software vendor, up 12.3% this week, specifically because its results showed AI expanding its contract values rather than eroding them. But it is down 18.2% for the year. The same sentence in Conte's piece describes both positions. Only research separates them, and none of this guarantees an active manager wins. Selectivity is a discipline, not a promise. Here is the other half of the answer. It sounds like the opposite of what I just told you. It isn't. You already know this story. A hare and a tortoise agree to a race. The hare is faster, and everyone watching knows the hare is faster. So the hare sprints and stops and wanders off toward whatever looks interesting at that moment. The tortoise never sprints. The tortoise also never stops. Over the whole course, the tortoise wins. Nick Murray has been telling advisors that story for decades because it maps onto your money almost one for one. The hare is what human nature wants to do with a portfolio. Pile into whatever is working. Sell whatever has lagged. Chase the S&P 500 when it looks like the only thing going up, and abandon small caps and international and the dividend payers when they look like dead money. It feels intelligent at the moment. It is simply how we are all built to keep score. The tortoise is what we do for you. We own many things on purpose. We accept that at any given moment, something you own will be underperforming. That is not a flaw in the plan. That is the evidence you are actually diversified. And once a year, on the calendar, we sell a little of what ran and buy a little of what lagged. I want to be honest with you about both halves of that trade. You are giving up the chance to make a killing in any one thing. In exchange, you are giving up the chance to be killed by any one thing. That is the trade, and it is the right one for a household that needs this money to last 30 years. Murray began this week's essay back in late 2024 when advisors were being pushed by their own clients to root out the chronic laggards and put the proceeds into the mighty S&P. One of them wrote to him, "I'm not just losing accounts, I'm losing friends." Murray names the disease precisely. He calls it the invariably fatal mental quirk of pro-cyclicality. In plain English, rising prices feel like rising value, and falling prices feel like rising risk. Neither one is true, and acting on either one is what turns a temporary decline into a permanent loss. The only way the tortoise loses this race is if something forces him off the course. That is the entire job of the cash buffer, and I will come back to it at the end. So when the financial press announced these past few months that diversification was suddenly working again, Murray's answer is the line I would ask you to keep. Diversification never stops working. It can't. The tortoise always wins over the course of the whole race. The numbers back him up. Year to date, small caps are up 22.5%. The equal weight S&P 500 is up 14.9%. The cap-weighted S&P 500 is up 13.4%. The very positions clients wanted to sell 18 months ago are the ones carrying this year. Murray does not use the rotation as an excuse for complacency, and neither do we. He notes the forward price-to-earnings ratio of the S&P 500 still sits a full standard deviation above its 30-year average, which does not predict anything. It simply means the market has no margin for error. His line on the bear case is the one to keep. Hope isn't an investment policy, which brings us to your position that we are excited about. Copart CPRT is the largest online auction marketplace for salvage and damaged vehicles. Insurance companies send it total loss cars. Copart stores them on land it owns, handles the title work, and sells them through a global online auction to buyers in more than 190 countries. It takes a fee on both sides. It is a two-sided network built on physical land, and it has been one of the great compounders in the history of the U.S. stock market. It is also down 24.2% this year and roughly 54% off closing high. It closed Friday at 29.66. At 4.5% of the portfolio, it is your fifth largest position. So this deserves a real accounting. Here is how it got built. In 1972, Willis Johnson came home from Vietnam with a Purple Heart, sold his house, and bought a salvage yard for $75,000. His wife Joyce agreed to move the family into a trailer on the lot. She later wrote that she never got used to the mice chewing on the walls at night. He founded Copart in Vallejo, California a decade later and took it public at $12 a share. And a 19-year-old asked Johnson for a job. The kid was dating Johnson's daughter and wanted to drop out of college to learn the business. Johnson said fine and handed him a broom. His name was Jay Adair. He swept floors, drove forklifts, and untangled DMV paperwork. Adair became chief executive 21 years later. And the decision on this timeline that built the moat is the middle one, when Copart shut down its live auctions entirely and moved every sale online, years before anyone else in the industry. Four numbers tell you why this matters. 17.7% a year. That is Copart's compound return since its IPO. $1. That is Jay Adair's annual salary, every year since 2009. In the depths of the worst market since the 1930s, Copart asked shareholders to let Johnson and Adair give up their $750,000 salaries and all cash bonuses for 5 years in exchange for options. Adair's words to shareholders: if the stock price doesn't go up in the future, we work for free. 23.6%. That is total loss frequency today, the share of damaged vehicles insurers write off rather than repair. It was roughly 8% when Adair joined in 1989. That arc is the whole thesis, and nothing this quarter changed it. Adair returned as chief executive effective July 31st and said his intent is to lead the company for the next 10 plus years. In his words, this is not an interim arrangement. Now, we are not adding to this position on the CEO news alone. We are holding it, and the fiscal fourth quarter report in early September is the next real test. The full bear case sits alongside the bull case in the written review. Now to the portfolio. 23 of 29 holdings rose this week. Here are the 5 best by weekly price change. ServiceNow, up 12.3%. The fuel is still the July 22 second quarter report. Revenue of $3.99 billion, up 24%. And the AI products portfolio crossing $1 billion in annual contract value. This is the name the market spent the first half of the year treating as AI's designated victim. NVIDIA, up 11.6% on a single sentence. On SpaceX's first earnings call as a public company, Elon Musk said they had decided to build exclusively on NVIDIA. SpaceX disclosed second quarter capital spending of $18.37 billion, of which $15.83 billion went to AI infrastructure. Ulta Beauty, up 10.2%, with no company-specific announcement at all. That was the rate relief rally lifting consumer discretionary. Broadcom, up 9.9% on the read-through from Palantir's results. Broadcom is the clearest expression in your portfolio of Alger's deeper in the stack point. And installed building products, up 9.5%, which reported record second quarter results Thursday. This is the most rate-sensitive position you own, and it will be the loudest signal in your portfolio when the Fed finally moves. And the 5 worst. Diamondback Energy, down 7.4%. The arithmetic is simple. West Texas Intermediate Crude Oil, WTI, fell 7.7%. Diamondback is still up 25.1% for the year. General Motors, down 1.4%, with no company-specific news at all this week. Interparfums, down 1.3%, after missing by 2 cents and holding guidance. It is up 45.0% for the year, so a pullback that size is unremarkable. S&P Global, down 0.9%, in continued digestion of its July 28th report. The stock is down 21.9% for the year, and that is a genuine problem worth watching. We are giving management 2 more quarters of clean reporting before drawing conclusions. And Alphabet, Google's parent, down 0.5% on post-earnings drift after raising full-year capital spending guidance to $195 to $205 billion. Look at that asymmetry. The 5 best gained between 9.5% and 12.3%. The 5 worst, excluding Diamondback's oil-driven decline, fell between 0.5% and 1.4%. That is what a strong week looks like inside a portfolio of quality businesses. Trace the whole thing once, top to bottom. A weak payroll number lowered the odds the Federal Reserve raises rates in September. Lower rate expectations lifted the present value of distant cash flows, which is why long duration growth stocks and gold led every other asset class this week. They also lifted mortgage sensitive housing, which is why home builders gained 7.2% and installed building products gained 9.5%. Separately, hope for a negotiated reopening of the Strait of Hormuz knocked 7.7% off crude, which is why energy was the only sector down on the week, and why Diamondback fell 7.4%. Every one of those moves was rational given the information, and not one of them tells you anything about where these businesses will be 5 years from now. That distinction is the whole discipline. 1. The index owns both sides of the AI trade. Coherent gained 44.2%, and the trade desk fell 23.5% in the same week in the same index. Research is what separates them, and we do that work on every position you own. 2. Diversification never stopped working. Small caps are up 22.5% this year against 13.4% for the S&P 500. The positions clients wanted to sell 2 years ago are carrying this one. 3. A cheap stock with an aligned owner is worth more patience than a headline suggests. Copart is down 24.2% for the year, with a chief executive who returned to take $1 a year and committed a decade. That is not a reason to buy indiscriminately. It is a reason to require actual evidence before selling. Nothing in the data this week requires you to change anything. The cash buffer stays where it is, 18 to 36 months of planned withdrawals in cash and short reserves. That is what makes it possible to ignore a bad September, and seasonality says to expect one. August and September have been the 2 worst months of this century for stocks. Rebalancing happens on the calendar, not on the news. If your circumstances have changed, a retirement date, a liquidity need, a tax event, that is the conversation worth having. Quick reminder, this video is general education, not personalized advice. I'm not an attorney or CPA. Please talk to your own advisor, attorney, and tax professional before making decisions. Full disclosures in the description.